Okay. So today's class is to revise or to look into the coverage or topic for your final exam. All right, your final exam would be on the 14th of August. Okay, so in terms of the coverage for your final exam, I think that I have listed down. Yeah, so we have, let me see. Um, how do I go about this? Hold on, yeah. I need to open up. Give me a few minutes, yeah. I need to open a file, open recent file. Oh, where is it? Oh, I couldn't find it. Okay. Okay.
Assalamualaikum, Madam.
Sorry?
Yes.
Okay. So, all right. So these are the topics for your final exam. Yeah. So you have your corporate tax, and then you have your RPGT, then you have tax incentive, and we also have your withholding tax and your double tax agreement. Yeah. So all these topics have been covered during the semester. All right. RPGT was covered earlier. I think that it was in week 5 when we had the online teaching. Yeah. So it's all recorded. And then, all right, for the first question, all right, will be on the corporate taxation. Yeah, on the corporate tax, all right, is always looking at the given a profit and loss account or statement of comprehensive income. So you are given income and expenses. From profit before tax, you have to compute your chargeable income, right? So for your chargeable income, you have to come back to the format for your chargeable income, which are starting from a profit before tax plus your non-allowable expenses, right? And then if there is any double deduction, you minus in terms of income, any non-business income you deducted, all right? And then any non-taxable income also is taken out from the profit before tax. So you have to do the adjustment. And for this question, I suggest that, all right, normally you have the profit and loss account, they have notes number 1. So you have item 1 to 3, right? So I suggest that you put a numbering, all right, in your answer starting from profit before tax. Okay, now you go into note number 1. So you write note number 1, then only the list of the expenses that you have to do adjustment. Okay. When you have to do adjustment, then you have to add or minus. But if there is no adjustment, all right, for example, if the expense is allowable expense, then you don't have to do any adjustment. So make sure that you put nil in your answer, all right? So that nil carries a mark, 1 tick for that, all right, if you are correct. And then you have note number 2, then you put the item 1, 2, 3, 4. So it's easier if you were to refer back to the computation, for example, refer back to the notes, then you know where it is. And it's also easier for me to mark your paper. And then that's from profit before tax. Remember that you have to do the adjustment. Then you have your adjusted income, yeah? So if I were to rewrite, all right, the format for your, so remember that for every question, please make sure that you start every question on a fresh paper, yeah? So let's see that, what can we have here? Okay, let's see that starting from profit before tax. Why am I not having this? Okay, so we have profit before tax. Why is it not there? Disconnected. I hope so. Can we have profit before tax here? Okay. We have profit before tax. All right. Then you plus your non-allowable. Okay. Before comma Z. Right. Before you have, then you minus your, what do you minus? from profit before tax minus income, which is non-taxable income. What am I doing now? Wow, it's running, it's running. Okay, you have non-taxable income. What is a non-taxable income? Example is your gain on your disposal, gain of your fixed asset. So it's not taxable because it's a capital gain, right? Then you also have to minus your non-business income, right? So non-business income is income such as your section 4C and your section 4D, right? So remember that this is an investment income. So you call it as a non-business income, but still it's a taxable income. So what you do is that you have to take it out from your profit before tax, but you're going to assess that income later when you do other income at the bottom, right? So don't forget on that. But what is actually included here, all right, the non-business, whatever income, the non-business income that appears in your profit and loss account, that is the amount that you take out. All right, whether it's exempted or not, whether you have to compute the adjusted income of the income, adjusted income of that income. For example, you have rental income, for example, yeah, you have rental income gross. So that is the amount in your income. Yeah, so you have to take it out, amount that, then later you do the adjustment at the bottom. Okay, then only you add your non-allowable expenses. All right, so then this one refer to your section 39 lah. So any expenses which is not incurred wholly, exclusively in the production of your business income, right? So you have to add back. And remember that the expenses that you incur may be for your business income and could also be for your non-business income. For example, in the case of interest expense. So when you have interest expense, then you have to allocate. All right, allocate how much is allowable for your business income, how much is to be added back because that one related to your rental income, for example. So you have to apportion those expenses accordingly, right? So you have to do adjustment for that. And then section 39, but if you have double deduction expenses, so you must know what are the expenses that are listed as double deduction. Yeah, so once you have double deduction, you give a deduction one more time. So that's why it's named double deduction, right? Given one time in arriving to your PBT, now we give you another time of deduction in arriving to your adjusted income. All right, so you have this kind of adjustment minus your non-taxable income, non-business income plus your non-allowable expenses. But if there is no, in terms of your allowable expense, all right, so if it's allowable, it's either you have to put a nil on the item, yeah. So don't forget to put a nil. So from here you get your adjusted income. So write down the name of the term of the computation. Yeah, every term here will have a tick for that. Okay, adjusted income, and then from your adjusted income you plus your balancing charge. Apa tak jadi ni? Balancing charge, yeah. So balancing charge here, remember that sometimes it's given in the question. All right, but other time, all right, whenever there's a disposal of fixed asset, most of the time you have to compute your balancing charge or balancing allowance. So how to compute, then you have to show the workings lah of your balancing charge. So normally on the separate paper, then you show all your workings in order for you to compute whether the disposal of asset give a balancing charge or balancing allowance. So if a balancing charge, then the amount will be added after your adjusted income. Okay, and then you also have your capital allowance, right? Minus. So minus capital allowance, remember that this capital allowance is made up of your brought forward, right? It's made up of your current year, right? And then you also have your balancing allowance. Again, right, your balancing allowance, you do have to compute. Now, whenever there's a disposal of asset, then you have to check whether there's a balancing charge or balancing allowance. So if it's a balancing allowance, then it's given as a deduction in arriving to your, what you call statutory income. Okay, statutory income. So after your statutory income, it will be your loss brought forward, right? So remember that your statutory income, it could be, if you have one business, then you have one statutory income from your business one. You may also have business 2 or business 3. Huh? So you have to add on your each statutory income from each business, then come to your aggregate SI. So aggregate SI is here, right? If you have more than one business income, then only you minus your loss brought forward. Okay. From your loss brought forward, then you plus your other income. All right. So sometimes you call it as a other income, sometimes you call it as a non-business income, or sometimes you call it as an investment income. So all this is the same, all right? Non-business income or your investment income. So what are your other income? Then you have your section 4C, right? For example, your dividend and your interest. Okay, dividend, remember that for company, all right, Malaysian dividend is under single tier. So bila single tier, it means that the tax has been deducted at source. So as a recipient, you do not have to compute any more tax, right? So you don't have to pay one more time tax on the income of your dividend income. So that's why when you have a dividend income from Malaysia and it's under single tier, it means that you are not bringing that dividend again into the combination. That's why we put it as a final. All right. But you may also have a scenario whereby the dividend given out by the company is an exempt dividend. All right. So if an exempt dividend means that it's paid out of an exempt account, then you write down the dividend as exempt. But you notice that in your textbook, both dividend are written as an exempt dividend, right? But you have to understand that the final dividend as single tier is not exempted, right? It's just that tax has been paid at source. You have to pay tax, but it's just that you don't pay, right? But it was deducted from your dividend income. So it's not exempted. Have to understand that. And of course, you also have income from your overseas, for example, yeah, other than business in the banking industry, insurance, shipping, and airlines, all this income are exempted. We're talking about foreign source income. So you just put exempt, right? Whether it's from Hong Kong or from Singapore or from Japan. So all foreign source income is exempted. Okay. Remember that when we talk about interest, nominal interest from your fixed deposit, all right, for company, it's not exempted unless you fulfill certain criteria. All right, so you have to go back to your chapter interest income and see whether income that received by the company is exempted. But most of the time, interest under company is not exempted. So you have to put that certain amount here, whatever amount that you receive. And remember that if there is any expenses incurred in deriving to the interest as income, right, the interest from the fixed deposit, then that expense is deductible. Right, then you have your section 4D, and most of the time, section 4D is your rental income. Okay, and careful that sometimes rental income could be under section 4D, sometimes rental income could also be under section 4A. So if it's section 4A, then you have to assess at the top lah. All right, so you have business income from section 4A, rental. All right, but remember that how you differentiate is the company that provides that derive rental income, but also provides maintenance, all right, comprehensive maintenance and support service on the property, then the income from that property is regarded as section 4A income or business income. So when it's a 4A income, you can minus expenses, but you can also minus capital allowance. Then you come to your statutory income from the business. But if it's not provided comprehensive services or comprehensive maintenance, everything, support service is not provided, then the rental income is assessed under section 4D. And so sometimes you do have to compute your expenses, all right, related to rental, then come to your adjusted rental income. Okay, all right. 4D, normally we have rental royalty, so we don't ask a company on the royalty income, all right, but if there is any, then you just put in lah, all right, whatever rental or premium received by the company. So assuming that this is the only income that you have, then you have to compute your aggregate income. Okay, aggregate income. So how much is your aggregate income? So remember that the amount here is not that, I would say that it's not that, it's important, but don't worry so much about the figure, all right? But the term here is very important. I give take on the term, right? Not so much on the amount, but that amount is important because, all right, first when you after you have your current year aggregate income, then you have your current year losses, all right? if the company having losses, then the losses can be deducted here lah against your aggregate income. Then you have your approved donation. So I want you to refer to approved donation on chapter 4, right? Approved donation, because you have to understand that what are the expenses that you can actually claim under section 44. This is section 44 lah, approved donation, right? If for example, company give it to approved institute, right? Or company give cash, but if the company give something in the form of benefit in kind, can you actually claim that amount as your approved donation against your aggregate income, right? And remember that this amount is also restricted to 10% of your aggregate income, all right? Some students, 10% of the approved donation is wrong. Yeah, the 10% restriction is against your aggregate income. So if it's more than that, then you have to restrict. And then you also have zakat donation, zakat contribution, in this case a business zakat. All right, but this one is restricted to 2.5%. So you have to check, right? What if I say that, okay, for example, your here is wrong, right? The figure is here is wrong, but if you show me that your approved donation and your zakat is actually referred 10% or 2.5% of your aggregate income, all right, I still accept that as own figure, yeah, OF. So that also give mark similar to the amount, all right? So from here, then you have your total income. Okay, any question that you are not sure about your, so normally total income, or of course for company total income is also the same as your chargeable income. So normally we don't ask for tax liability, right? We ask for you to compute the chargeable income of the company. Yeah, so any question on your corporate tax? No question? Oh, very good.
Yes.
Okay. No question?
Yeah.
No. Wow, so good, huh? Okay. Okay, let's go to the second question. All right, topics is on mana dia? RPGT. Yeah. So I know that we have done this online, right? But I hope that the video, the recorded video, helps you to do this question, right? And how? Yeah. Do you have problem with RPGT? Very clear, RPGT. Yeah, if you have problem, you let me know, because that
For now, okay, madam.
so far so good, yeah. But I just want to let's go through. Alright, before we go to RPGT, since I dah mention RPGT kan. Alright, RPGT actually the concept is looking at your disposal price minus your acquisition price. Right, you have a property, and then because property in this case, remember, it's not under Income Tax Act, it's under RPGT Act. All right, so RPGT, we tax you on the disposal of your properties. So if there is tax, means that if there is a gain, that's what namanya RPGT, real property gains tax. Tax on the gain. So it means that you have to compare your disposal price and your acquisition price. So this is again is a statutory concept. Bila statutory concept, it means that, all right, you have to follow the law lah. If I say that acquisition price equals to whatever you pay for the property plus any expenses incurred, or what we call incidental cost in acquiring the property minus your capital receipts. All right. Even though you do another way around, right, where you say that capital receipt I want to deduct from your disposal price, is wrong. Why? Because it's a statutory concept. The law say that AP is A, B, and C, right? So you cannot have A, B, and then C you want to put under disposal price. It's wrong. Yeah, so you have to show me the workings on how you compute your acquisition price, and then you compute your disposal price. From there, you have your chargeable gain, right? From chargeable gain, you remember that given the disposer is an individual, right? So you have exemption, yeah, exemption of 10% or 10,000 ringgit, whichever is higher, okay? After the exemption, you also have your allowable loss. All right, so you have two types of losses. One is what we call allowable loss. The other one is a loss relief. Yeah, allowable loss means that any disposal of properties that was under after 1st January 2010, right? That give rise, if there is a loss, means that the disposal price is below acquisition price, then you have allowable loss. So that loss is given as a deduction for future disposal. So if you have previous disposal that give rise to allowable loss, then the loss can be used, all right, to set off against your chargeable gain in the current year or in the future. All right. So it says that, for example, remember that if you have two properties, right, and then you dispose one property in January that give you allowable loss, another property in May, for example, or in the same year, right? So RPGT, it doesn't work on the year of assessment. It works on each property, right? So even though it's under the same year, but the disposal of in May, right, January you have allowable loss, so the loss here can be used to set off against your disposal in May. Yeah, even though within the same year, there's no year of assessment like year lah, in the same year. RPGT kita based on the current year. Okay, but the loss really, and remember that the allowable loss is after exemption. Yeah, then only you have the net, then you compute how much your tax liability depending on the tax rate, and the tax rate depends on the holding period. So you must know how to compute your holding period from the date of purchase, right, until the date of disposal. How to decide on the date of purchase or date of disposal depends whether there's a written agreement or there's no written agreement. So you have to look into that, how to decide on the date of disposal or date of acquisition. Right? So once you have computed your RPGT payable, means that times by the RPGT rate, that if you have any loss relief and that loss relief is deducted against your RPGT payable, then you have the balance of RPGT payable. Right? I hope that is clear. Under losses, we have allowable loss and we also have the loss relief. Okay. So that is generally, that is the theoretical part, all right, or the fundamental or the principle of RPGT. Compute the disposal price, compute the acquisition price, and compute the tax liability, right? But of course, there are also some kind of scenario where the RPGT, for example, in the case of inter vivo, in the case of giving of a gift, all right, from one person to another. We're talking about inter vivo, it means that the disposal of asset from one party to another, and this party are immediate family. So we're talking about from parents to their children, from grandchildren, from grandparents to grandchildren, all right, or from husband and wife, yeah. So you have to understand that when it's a gift, it means that you give, all right, disposal, there's no disposal price, right, to the donor, right? The one that give the disposal, we call it as a donor, and the one who receive, we call it as a recipient, yeah. So in this case, the donor, to the donor upon disposal, right? Remember the RPGT is on the disposal. But in this case, the disposal of asset as a gift to immediate family is given as a no gain, no loss. It means that, right, donor don't have to pay tax on the disposal of the asset to their related party. In this case, to their immediate family, right? But remember that the government, right, when you say that, okay, I give you no gain, no loss, it's not that no tax at all on the property. It's just that you transfer, right, the liability of paying the tax from the donor to the recipient actually, yeah. So it means that if the recipient happen to dispose of the asset later, right, to their either to third party, all right, so then the recipient will be exposed to RPGT, yeah. All right, so then to the recipient, when they dispose of the asset later, right, of course they have to compute RPGT, so then they have to know how much is the acquisition price, right? So the acquisition price of the recipient, when he actually receive the property, for example, from the father, right, the recipient must know how much is the acquisition price. So in the case of inter vivo, all right, the AP is the AP of the father plus any permitted expenses incurred by the father. So the permitted expenses here refers to the capital expenditure incurred by the father lah. For example, all the renovation incurred by the father, right, or any expenses incurred in preserving the title of the property. So all these are capital expenditure. Yeah, of course, the father will not have to incur any disposal costs or incidental costs related to disposal because you dispose to your children, for example. Yeah, so there's no such thing as a brokerage fee, all this thing lah. Yeah, all right. So that is on the inter vivo. Okay. Uh, but remember that this donor, or like we also have the circumstances whereby it's not no gain, no loss, but the disposal will be at market value if the donor is a non-citizen. All right, so you refer back to the textbook, it will explain further. Right, the donor can be no gain, no loss provided the donor is a Malaysian resident, a citizen, right, or permanent resident. But if they are non-citizen, then disposal will be deemed at market value. Right, so they will have to pay some tax on that. Okay. And then the other scenario under RPGT is when you have your individual, all right, dispose a property to a control company. Control company means that company which is owned by himself or owned by the wife or any of his relative. All right, so in that case, there's two conditions here. One is that it is disposed to the control company. The second one is that in return, all right, that individual receive 75% at least. All right, remember that the individual transfer property to the company. All right, and in returns, all right, so when you transfer to company, you cannot, of course you don't transfer that at zero value, right? Must be some value of the property. Right, talking about property here. So when you transfer, right, you must know the value of the property. So how the company pays, whether the company pays you cash or the company, all right, if they don't have enough cash, what they do is that they give you shares in the company, right? So if the company pays you out in cash 100%, then it doesn't fall into this scenario. It's 4 o'clock. It will only fall into the scenario if the company, control company, pays you in the form of shares, and that shares constitute at least 75% of the total value of the transfer. Yeah, so you have to have two conditions here: individual transfer to a control company, and in return the individual get at least 75% in the form of shares. Okay, so when you have these two conditions, to the individual is a no gain, no loss, right? To the individual is a no gain, no loss. So that is the first implication of this whole transaction. Yeah, so I will put this like this, right? So this one is very important. You have to understand this, right? One is that to the, tak masuk kotak. Sini, sini, sini ya. So that is the condition. Okay, so to the disposal is no gain, no loss. To the company, all right, that actually receive the property. Remember that the company has to pay, either pay, in this case is pay in shares, plus it could also be, for example, 80,000, 80% in the form of shares, 20% in the form of cash. All right, it's a combination or it's purely in shares. It depends, yeah. So if the company pays in cash also, then that also be taken into account. So to the company, all right, what is the acquisition price? Because why? Of course, when you talk about the first individual, you don't have to pay any tax because it's a no gain, no loss. But to the company later, now the company has a property. So if later company wants to dispose of this property, then it will be exposed to RPGT. Yeah. So when you are exposed to RPGT, then you have to determine how much your acquisition price and how much is your disposal price. Acquisition price of the property, again, it goes back to when you first acquired from the individual, right? So when you first acquired from the individual, you have to say, how much is my acquisition price? So to the company, under this scenario, the AP is AP of the donor. Again, donor here is the individual plus the PE. So it doesn't matter how much the company actually pays to the individual, but the action price depends on how much is the AP of the individual plus PE of that individual, right? So careful with that. Then if the company disposes of property, then you know how much the disposal price, depending on at the time of the disposal, how much is the price consideration, right? And then you have to compute lah if there is any cost, any capex incurred, or there is any cost incurred, or what we call incidental cost on the disposal. So all these will be part of your disposal price. Okay. Okay, and then all right, another implication is that the shares received by the individual from the company is what we call RPC shares. Yeah, the shares is what we call RPC shares, and RPC shares is subject to RPGT upon disposal. So when the individual now have RPC shares, when he dispose of the shares, then you have to compute the RPGT of the shares. Again, whenever exposure to RPGT, you can compute apa? Acquisition price and the disposal price. Now you have to know how much is the acquisition price of the shares. Then it goes back, because this one is under special scenario. Then the shares, actually the AP of the shares is AP of donor plus PE minus any cash. Cash here refers to, for example, let's assume that the property value is 1 million, right? So when the individual transfer the property to the company, company pays out in the form of 800,000 shares plus 200,000 ringgit in cash. So in this case, the shares contribute about 80%, yeah, of the consideration. The balance 200,000. So the cash that we are referring to here is that the here is actually the one that we are referring to, 200,000 just now lah. So the AP of donor, whatever incurred by the individual on acquiring the asset, any capital receipt by the donor, for example, plus any PE, any capital expenditure incurred by the donor, minus cash received by him, right? So that's your AP, and of course your DP depends on how much is the disposal price of the property, disposal price of the shares. So now we are referring to the shares, okay. Shares here, right? If you have shares in the company, you have to remember that the shares here could be, right? It could be RPC shares, it could be a non-RPC, yeah, depending. If you get the shares because of the transfer of the property, then the shares is RPC. But if you already have shares in the company, all right, because you purchase the shares, for example, so those shares are non-RPC. And the one that is subject to RPGT is only the RPC shares. So if you have all the shares, both you have RPC shares, you also have non-RPC shares. If you were to dispose of all the shares, then you have to apportion the shares accordingly. All right, because only the RPC shares is subject to RPGT. So you have to apportion the disposal price of the all shares. Okay. Okay, that is on, and then of course, then you have the other section. It talk about RPGT on what? We also have RPGT on company. All right, company to company. What is that? Confuse that. Okay, tu cantik sikit. Company to company. All right, you nak juga company. Confuse that. Company, right? So you do have to look at the scenario. I think that there are 3 scenarios here. For example, transfer from one company to another. All right, it could be a related company, right, due to merger or whatever lah. All right, so that is another topic. So if you have fall into that, all right, because this one can give you exemption, right? But you have to make sure that you fulfill the requirement, then only you get exemption. Exemption means that the disposal is not subject to tax. Yeah, okay. And of course, the other part of the RPGT is the last, whereby we have the 4 scenarios. For example, when there's a deceased person, all right, then distributed the asset or the properties of the deceased person distributed by the executor. So you have to know to the recipient or to the beneficiaries how to decide on the acquisition price. It could be in the market value, for example, yeah. To the deceased person, of course, it's no gain, no loss. But you have to refer what is the AP of the beneficiaries, right? Whether is it the AP of the donor or the deceased person, or it could be a market value. So it depends on the scenario, right? So you have the executor, legatee, and then whatever lah. There are 4 scenarios there, yeah. Yeah, in terms of the administration for RPGT, company has to both disposer and acquirer are required to submit RPGT form. So we call it as a CKHT1 and CKHT2. What is CKHT stand for? Anyone? CKHT is the Malay term. Cukai hasil tanah. Alright, so you have two types of, oh, Astagfirullahaladzim. Okay, it's a very, okay, lightning. It's raining out there, yeah. Okay, CKHT1 and CKHT2 means that one is for the disposer, the other one is for the acquirer. All right, so you have to submit the form to RB within 60 days. All right, and on top of that, all right, the disposer, remember the disposer has to pay to the acquirer. Let's say that the value of the property is 1 million, right? Banyaknya 1 million, 100,000 je lah, right? 100,000. So 100,000 ringgit, the property, which is very cheap, okay, you have to pay to the disposer, right? Because you acquired the asset, the property. But the law requires that you cannot pay 100% to the disposer. You can only pay him the most 97%. Why? Because the 3% is what we call retention money. The acquirer, under the law, the acquirer is required to pay to RRB 3% of the disposal price. All right, so what happened is that RB is very clever. They collect tax. So remember that the disposer is the one who's supposed to pay the tax. But the RB is very smart. They collect tax from the disposer, right? Before the money goes to the, collect from the acquirer before it goes to the disposer, right? So they collect tax in advance, then only they compute how much is your RPGT payable. And remember that RPGT in Malaysia is not under self-assessment system. So what you do is that you have to provide all the documents, and then Inland Revenue Board will do the computation for you. But all right, if you know how to compute, that will be better, because you know that how much is your RPGT payable before you actually being informed by the RB. And if there is any dispute, then you know where the dispute could be from, yeah, and maybe you can fight for it lah. Yeah, of course, we always fight for a lower tax liability, whether it's an income tax or RPGT. Okay, that's a 3% retention money. All right. What else? Okay, then the RB will compute the RPGT, and if then they come up with the assessment. All right, so it depends if the tax liability computed by RB is lower than the 3% retention money. So the balance will be refunded direct to the disposer, because it's his money actually, yeah. It's just that we collect in advance. But if that is not enough, means the RPGT payable is more than 3%, then they will collect more from the disposer, because now the disposer have the 97, yeah. They are very rich now. They have a lot of cash. Okay, provided that the property is there's no loan anymore on the property. Okay, so that is on the RPGT, including the administration of that. All right, and the last topic that is in your final exam is on the tax incentive. Right, we have gone for all the topics, is it? We have number 1, we have non-corporate tax, RPGT. Oh, ada lagi WHDT. Okay, tax incentive first. Alright, incentive here, remember that we have gone through tax incentive under Income Tax Act or the Promotion of Investment Act, PR. Right, we have the pioneer status. We do have investment tax allowance, but we also have reinvestment allowance. Right, so remember that for this ITA and pioneer status, it comes together. Right, it means that it's under the same criteria. Alright, it's under the same. It's just that it's a mutually exclusive, ME. It means that you cannot go for both. You have to choose whether pioneer status or ITA. All right, so that's why the question, if under pioneer status or ITA, you have to do both computation. All right, because we require you to compare which one is better for the company. Is it under pioneer status or under ITA? Yeah, pioneer status, remember that you have the non-promoted, promoter, and then you have the pre-pioneer period, then you have the pioneer period. And remember that all your pre-pioneer is also known as a non-promoted. So the losses to be set off against pioneer income or statutory income, then only pioneer income, all right, cannot be, pioneer loss cannot be set off against your non-pioneer. All right, so pioneer status, I do not know, I see it more complicated as compared to ITA. Right, ITA, you determine your SI. Then from the SI 70%, then you compute how much is the capex, which is eligible for your investment tax allowance. Yeah, so whatever capex that you incur, And then 60% of the capex is given as a deduction against your 70% of your SI. Yeah. So if you were to do pioneer status and ITA, when you start your pioneer status, you will also have your SI already, statutory income. So when you do your ITA, you don't have to redo your tax com. All right. You can start from your statutory income, or you can start from 70%, right? 70% of SI, because it should be the same, right? You don't have to spend more time on redoing the same computation. All right. You can just use whatever that you get from your pioneer status, do that in your investment tax allowance. Okay. That is 70%, 60%. And remember that under ITA, you not only have, you have 3 types of SI, right? You have the 30% SI. Okay, we have here, let's see here that we have 30% SI. And then you have the unabsorbed SI. One more. And then you have non-promoted SI. So these 3 give you aggregate SI, then only you minus your loss brought forward. You get that? Okay. So the format must be right lah, right, in order for you to get the right answer. Then only you plus your other income. So this is for investment tax allowance lah. Right? Kalau pioneer maknanya you only have the non-promoted SI. Okay, then remember that the 30% of SI goes as a deemed income under pioneer status. Okay. Yes, I did not cover very much on the reinvestment allowance, but I have shared with you the chapter on reinvestment allowance. So in terms of reinvestment allowance, all right, the criteria is actually for automation, for expansion, all right. So the criteria is very specific. Yeah, it's not for promoted activity ke promoted product. No, it's not that. It's for automation. That's why namanya reinvestment allowance. Alright, you incur capital expenditure in order to invest in the company lah. Reinvestment. So that's why, but the computation of RA is similar to your ITA in terms of the computation. So means that you have to compute the SI, 70% SI against 60% of your capex. Alright, and again under RA, you also have this 30% of your SI and SI, and also SI from your non-promoted activity. Okay, so the computation is the same. So I hope that you can also refer to the textbook on your reinvestment allowance. And remember that in terms of the format, all right, I would like you to do the column lah, all right, the table format, where you have your year 1, year 2, year 3, okay, year 4, year 5, whatever lah, right, and then you work like that lah. Okay. Question on tax incentive. Are you okay or not? I've been talking all by myself, yeah?
Okay, insyaAllah.
Okay, madam, okay.
Yeah? All right. Okay, then the final question is on your withholding tax. Ada tak? Tak ada. Mana withholding tax lah? I tak cover ke? Here kat sini. Right? Okay, withholding tax and double tax agreement actually is under 2 chapters, yeah? So you have 1 chapter on withholding tax and another chapter on double tax agreement. I have covered double tax agreement, right? Okay, so withholding tax, you must know what kind of income received by the non-resident person, right, which is subject to withholding tax. It's not all income, right? It's not all income. It's only your 1, 2, 3, 4, okay, your interest, your royalty, whatever, contract payment, special class of income, public entertainer, right? I'm the public entertainer. Then you have the other one is, what is the other one? I tak ingat. Okay, so they are the income paid to non-resident which is subject to withholding tax. So talking about withholding tax, you have to understand what is the, kat sini tak apalah, I tulis withholding tax kat sini lah. Okay, so we're talking about withholding tax. Alright, you have to understand the, of course, the definition. Right, the definition of each income. Yeah, so and then we have to understand what do you mean by withholding tax, right? Means that you withhold tax. So it means that whenever you make payment to non-resident person, you can't pay everything, but you have to withhold certain percentage depending on the tax rate, depending on the types of income. So you hold that income, and this income is actually tax, all right? That you pay, you have to pay to RB within 30 days. So you have to understand the responsibility of the payer, right? So responsibility here must be at least ada dua. Alright, means that you have to withhold tax and then you have to remit within 30 days to RB. And of course, we're talking about non-compliance issue. What if you do not withhold tax? Or some company withhold tax but fail to pay to RB within 30 days. Alright, so when you non-compliance, what is the implication? Right, for example, remember, first is that your penalty of 10%. Okay, and then you have the, what else? Expenses is not allowable expense, yeah, and then it becomes debt due to the government, and then what else? Apa lagi implication dia? 10% and penalty, right? But remember that now the government say that if you don't pay the withholding tax or you have not been complying to the withholding tax, you are given some period until submission day, right? Remember that you are given 7 months. All right, for you to pay the withholding tax plus the amount due or the penalty to IRB. Then if you have paid everything, when you submit your income tax return, then the expenses now become allowable expense. Yeah, allowable is the expenses that you pay to the non-resident. For example, the royalty itself, right? But you're talking about the penalty is always non-allowable expense. Yeah, but if it happen that you have not complied with withholding tax and you did not pay the withholding tax plus the penalty to government, to RB, but when you submit your return, you claim the expense. For example, the royalty expense that you pay to the non-resident person, you claim that royalty expense as an allowable expense. So when you have that, that is wrong, right? So when it's wrong, the return that you submit, we call it as an incorrect returns. Right, incorrect returns. So what happened to incorrect returns? The penalty is 100% of the 100%, yeah, of the tax under charge. So you have to know what do you mean by tax under charge. All right, so you have to know the implication of submitting an incorrect returns. Right. Okay, that's on the withholding tax. Of course, the definition of each income lah, and more importantly, not only definition, right? You also must know the derivation. Right? How do you know that the income is derived in Malaysia? Why? Because only if the income which is received by the non-resident person, if the income received is derived in Malaysia, then only the non-resident is subject to pay tax to Malaysia through withholding tax punya mechanism. Right? If the income is not derived in Malaysia, then it's not subject to pay tax to Malaysia. If it's not subject to pay tax, then you are not supposed to withhold tax. Right? So it goes back to the derivation of the income. Yeah. All right. So you must know the derivation, and each derivation for each income is different. Right? You have to check on that. All right. When it comes to your double tax agreement, where is double tax agreement? Tak ada. Okay. I thought I saw it somewhere. Okay, here, double tax agreement, right? Remember that under that topic, the first few pages talk about the method of tax relief, right? So we have 3 types of relief. We have the exemption, we have the credit, we have the deduction. And remember that we're talking about double tax agreement, right? All this while, when you do tax com, whenever you have income from overseas, those income are exempted, right? Then when you do your double tax agreement and suddenly the foreign income is now taxable. Why is it like that? Why is it under double tax agreement topic, your foreign income is taxable? Why? Anyone? Why?
Okay.
Huh?
Okay.
Yeah, why banking? Why is it taxable? Kenapa tiba-tiba taxable lah pula? Why?
It's considered all around the world.
Around the world, okay, somewhere there, but a better term that can use? Why now? All right, whenever you have income from overseas, now is taxable. Why is it now being, okay, foreign income is now is exempted or given as a credit or given as a tax deduction? Why? Why? Exam bila ni? Okay, so why all this income is now being taxable? Because when we talk about the income here, we are talking about income under visa. Anyone know what is a visa? What is visa?
Banking.
Okay,
I've got I. S is shipping, I think.
betul.
Aeroplane.
Apa lagi ni? Actually?
Aeroplane.
Airlines.
Oh, airlines.
I for insurance. So for this industry, banking, insurance, shipping, and airlines is a special industry, right? Income tax purpose, these are the special industry whereby the income from this industry is under world scope, right? Means that wherever income is derived by this industry, as long as the company is a Malaysian resident company, then the income is taxable in Malaysia. Right? All the one that we are doing is not banking insurance, right? It's a manufacturing company. Most of the time it's manufacturing, right? So this company, whatever income derived, I mean that foreign income is exempted. But in the case of banking, insurance, shipping, and airlines company, foreign income, wherever derived, is taxable in Malaysia. So why then? Remember that, okay, for example, I'm having a airlines business, all right? Let's say that Malaysia resident company, for example, all right, let's say it's a Malaysia Airlines, right? So income in Malaysia, of course, taxable in Malaysia. But when the company, when the airlines goes to Australia, for example, all right, of course, the income is derived in Australia, yeah? So whatever income derived in Australia, because Malaysian company, Malaysian resident company, so Malaysia will also want to tax that income that is derived in Australia. Why? Because the law say that airlines, wherever income derived, tax in Malaysia because you are a Malaysian resident. Okay, so okay, I pay to Malaysia. But at the same time, Australia, all right, because the income is derived in Australia, Australia also wants to claim tax on the income. So the Malaysia Airlines has to pay tax to Australia, right? On the same income, also has to pay to Malaysia. So because of that, now the income, the one income that you have to pay two taxes. All right. So what we do now, we have an agreement between countries, Malaysia and other countries, to agree on how can we relieve the tax burden, right? How to relieve is that we have an agreement. Okay, in the case of Malaysia and China or Malaysia and Australia, so if there is an income derived in Australia, for example, in the case of Malaysia Airlines just now, how are we going to relieve the tax burden of the company? Because tax is on the same income, right? Otherwise, nobody wants, if you don't have any agreement, then nobody wants to do business overseas because it's a costly, because tax is a cost burden to the company. So they do it. Okay, I agree lah. So Malaysia, okay, let's say that, okay, for example, all right, Malaysia and Australia, okay, we say that, okay, we give you exemption. So Australia says that, Malaysia say that, okay, income from Australia is exempted. So you don't have to pay tax on the income from the Australian in Malaysia, right? Because Australia also tax them. But in talking about Malaysia and Japan, for example, okay, we only agree that, okay, it's going to be a tax credit. So credit then means that it's not given as an exemption, but whatever tax paid in the Japan will be given as a deduction against your tax liability in Malaysia, right? So in other words, you are given a credit, which is actually, it's good also, right? Not as good as as your exemption, but it's better, right? Better than nothing. Yeah, better than paying 2 taxes. So in Malaysia, you are given a relief in the form of tax credit, or you can also be given relief in the form of tax deduction. Okay, so in the example in the textbook, mana? Hold on, yeah. Where is the... nak buka apa tadi ya? Tak ingat dah. Double tax agreement ya. Hold on ya, I cari jap. File, recent file, double tax agreement. Okay. Where am I? Are you seeing this double tax agreement now?
Yes.
Yes. Okay, sama. Cancel. Okay. So in this example in the textbook, it shows you that these three, the company having a plan to have a business in 3 countries: Nirvana, Paradise, and Heaven. Right? So it means that if the company have a business in Nirvana, they are given full exemption in Malaysia. If having a Paradise, then full credit in Malaysia or full deduction in Malaysia. So they give you the 3 scenarios, right? But remember that, for example, if I were to do in practice, right, in reality is that, for example, you have a Malaysia Airlines, all right, you may have incurred the same income, but you may get it from Malaysia, all right, then you have Australia, then you have to go to Singapore, Japan, and everywhere lah. Right, wherever countries that you go, then you will derive an income, right? And remember that the DTA between Malaysia and Australia is not the same as Malaysia and Japan. Right, so I have to look at the DTA and how is the tax credit or how is the tax elimination method. Yeah. So then you have to compute all your income. In this case, remember that you have income from Malaysia, you also have income from overseas. So you add on together total income. So the method is still the same, right? The method is still the same, whereby you have to come to your total income. All right. You add on your Malaysian income and your... buat apa ni ya? Okay, silap ada pen. Okay, you have your Malaysian income and your... Okay, you have, remember that in this here, you have Malaysian income and your foreign income, then you compute your total income here. Yeah, total income, which is also your chargeable income, right? Total income, then if you're given exemption, so this is how you do it. If you're given credit, it's how you do it. So if talking about Malaysia Airlines, when they do the computation, they have to compute all total income from Malaysia and overseas, put together everything. All right, then compute your chargeable income in Malaysia. Then if it's a tax credit, siapa? So, alamak. Alamak. Okay, I need a break. I need to fill up a Google form to fetch my son from the Setia Budi. Okay, let's take a break. A few minutes break. Kat mana nak break? I tak tahu. I pause kejap. Resume recording. Okay. Remember that in reality is that wherever you are, for example, wherever income you derive, you have to put together also income and your foreign income. Then, right, you look at whether it's a tax exemption or credit, then you do the computation accordingly, right? And remember that Malaysia don't have agreement with all the countries, yeah? So if you have agreement, for example, given as a credit, then you use bilateral. Kalau there's no agreement, there's no DTA between Malaysia and the other country, then you use the unilateral, right? If you look at in the textbook on page double tax relief here, page 543, you see that there's a computation on double tax relief here, whether it's a bilateral and unilateral, all right? Bilateral means that if you have an agreement, then you're going to use the formula. Right, so what is the formula is that you have the Malaysian tax payable. So remember just now you have the total income. So whatever total income times by 24%. So that will be your Malaysian tax payable, right? Assuming that you're not given exemption on the foreign income. Yeah, because this one is given as a credit. So the income is computed, whatever your total income times by 24%, then you minus your bilateral credit. So how to compute your bilateral credit is that your Malaysian tax payable, whatever that you computed above, times by your statutory income, your foreign source. So for example, if you have income from 2 countries, then country A, for example, what is the income that you receive from country A over total income? Yeah, but maybe in another country, so then you compare that with your foreign tax payable in that foreign income. So assuming that in the example just now, you have 20,000 that you pay in the other country, so that is your foreign tax paid. So you compare which one is lower, whether is it the number 1 or number 2. So that is the tax credit given against your tax liability that you compute just now times by 24%. Yeah, the tax payable. But if you don't have any agreement between with the country, then you have to use the unilateral credit. Yeah. So the first part, all right, is the same. Income over your total income times by Malaysian tax payable. It's the same formula. It's just that the second part, you're only comparing that not foreign in tax to given is that you times by half. So katalah before this you pay foreign tax 20,000, but because there's no agreement between Malaysia and the other country, am I recording this? It's recorded, right?
Yes.
Yes.
Yes. Yes.
Okay. Okay, so instead of given 20,000 tax credit, for example, you are now having only 10,000 because why is half of the foreign tax. So remember that it's not good unilateral because why now you're comparing the one with the first one tadi you compare katalah your foreign income tax over total income times the Malaysian tax payable is let's say lah, alright, it's 30,000. Then 30,000 you compare with your foreign tax 20,000, so whichever is lower. So 20,000 is given as a credit, right? But the other country, alright, they pay 20,000 juga foreign tax, but your 30,000 is compared with 10,000 ringgit. So whichever lower is the 10,000, so the 10,000 is given as credit. As compared to the 20,000 given as credit, because this one ada unilateral, this one tak unilateral. Alright, so the computation is like that. From tax payable, tolak bilateral ke, unilateral ke, or tax deduction. Right, so you have to know how to actually do the computation. Right, not only that under this topic, there are issue, for example, the permanent establishment. Right, in this case, for example, exemption of employment income. So if you are working in Malaysia, employed, alright, the non-resident person, you can be exempted on income, employment income in Malaysia, provided that the employment income is less than 60 days, right? Before this, we have all the permanent establishment. Yeah. So what do you mean by permanent establishment of that? Okay. Remember that this round, the exam, your final exam, taxation papers, whether it's tax 1, tax 2, or advanced taxation, is gonna be an open book, right? So when I say it's an open book, means that you can refer to your textbook, you can refer to your notes, but you cannot communicate to each other. You get that? Right? Because why we make it an open book? Because based on our midterm exam, which is supposed to be a closed book, we noted that there are some students that actually open book. Right? So it's not fair to students who are very honest that actually kalau kata oh close book, you close book. So it's not fair ada pula student yang pergi open book. Right? So in this case, just like for example, other professional paper, contohnya macam MIPA, alright, and CPA Australia, we are already on open book system. So when it's open book means that you can refer to your book, you can refer to your resources, right? You can refer to your notes, for example, but you cannot communicate to each other, right? So I hope that you honor that, the trust that we have given here. Yeah. Again, open book it doesn't mean that oh, it's open book is very easy. Sometimes open book is more difficult, right? Because the question will not be straightforward, right? You have to understand the concept. And most of the time when you talk about open book, then it's going to be a application question. Yeah, you have to apply the knowledge. I won't, I tell you in advance, for example, I won't ask you macam ni lah, what is the objective of tax agreement, right? Tax treaty, tak ada lah, because it's already there, right? I won't ask you that kind of question, but the question is more applied. So even though it's open book, you have to prepare for the exam. All right. If you are well prepared, open book is very helpful. But if you're not prepared, sama je open book ke close book ke, you tak boleh buat. Yeah, sometimes it's more difficult lah. Right. What else, huh? So that is double tax agreement. Settle lah all the questions, 4 questions. Okay. So I think that I have covered all for the what else? What else you want to done, right? I have covered all. Okay. Okay. Question?
Madam, the finals will be open book
Yes.
for tax only or all of the subjects?
Tax only. I don't know about other subject. You are not happy?
I mean, because tax is the last exam, so like
So?
open book, I was hoping the rest would be open book also.
But again, it's open book, but if you're not prepared, you won't be able, it won't help you much. Yeah, you still have to prepare for the exam. It will not be a straightforward question. Trust me, I have just submitted the exam paper yesterday. Right? Next question.
Did we do badly in the midterms, madam? Is that or?
Actually, I have not marked your midterm.
Oh, okay.
It's based on the other papers. Midterm bila nak marking ni? I have 3 midterms that I have yet to look into. Pray for us, yeah. We are very busy lecturer now. I don't know lah. All this work from home, all this online actually takes a lot more time. I don't know why, but because everything is in front of you, right? You cannot, you just cannot get away from it. Okay, maybe I should pause the recording unless you have a question.